Good afternoon, and welcome to the Enova International Second Quarter 2026 Earnings Conference Call. All participants will be in listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star then 1 on your telephone keypad. To withdraw your question, please press star then 2. Please note, this event is being recorded. I would now like to turn the conference over to Lindsay Savarese, Investor Relations, Enova. Please go ahead.
Thank you, operator, and good afternoon, everyone. Enova released results for the second quarter 2026, ended June 30th, 2026, this afternoon after market close. If you did not receive a copy of our earnings press release, you may obtain it from the Investor Relations section of our website at ir.enova.com. With me on today's call are Steve Cunningham, Chief Executive Officer, and Scott Cornelis, Chief Financial Officer. This call is being webcast and will be archived on our Investor Relations section of our website. Before I turn the call over to Steve, I'd like to note that today's discussion will contain forward-looking statements and, as such, is subject to risks and uncertainties. Actual results may differ materially as a result from various important risk factors, including those discussed in our earnings press release and in our annual report on Form 10-K, quarterly reports on Forms 10-Q, and current reports on Forms 8-K. Please note that any forward-looking statements that are made on this call are based on assumptions as of today, and we undertake no obligation to update these statements as a result of new information or future events. In addition to U.S. GAAP reporting, Enova reports certain financial measures that do not conform to generally accepted accounting principles. We believe these non-GAAP measures enhance the understanding of our performance. Reconciliations between these GAAP and non-GAAP measures are included in the tables found in today's press release. As noted in our earnings release, we have posted supplemental financial information on the IR portion of our website. And with that, I'd like to turn the call over to Steve.
Thank you, Lindsay, and good afternoon, everyone. I appreciate you joining our call today. In the second quarter, healthy originations growth and credit, supported by a stable macro environment, drove top and bottom line financial results that exceeded our expectations. Our second quarter results and our long track record of consistent and differentiated financial performance reflect the strength and resiliency of our business that is powered by our talented team, diversified product offerings, scalable operating model, and world-class risk management capabilities. Second quarter originations were strong across both consumer and small business, driving consolidated originations 27% higher year over year to nearly $2.3 billion, and marked the 11th consecutive quarter of consolidated year-over-year originations growth of 20% or more. Originations growth drove 28% year-over-year growth in the portfolio to $5.5 billion, with small business products representing 69% of the portfolio and consumer products accounting for 31%. Market demand and the credit we observed across our products drove our marketing spend this quarter, allowing us to efficiently scale our investments and originate loans with attractive unit economics. As we've discussed in the past, our unit economics framework, combined with our sophisticated technology and analytics, are designed to assess risk in real time, and the short duration and payment frequency of our products provide rapid feedback. This lets us react quickly not only to emerging risks, but to also quickly respond to opportunities we see in the market, as we did in the second quarter. With strong portfolio growth, revenue growth accelerated, growing 22% year over year to $929 million. Profitability grew even faster, with adjusted EPS growing 33% from the second quarter of 2025, marking our 8th consecutive quarter of year-over-year adjusted EPS growth of 30% or more. Positive credit was a key driver of our EPS growth, as the consolidated net charge-off rate of 7.3% declined both sequentially and year over year, and was the best we've seen in quite some time, as consumer credit improved and small business credit remained stable. Turning to our consumer business, year-over-year originations growth and credit performance were the best we've seen in 2 years. Consumer originations growth accelerated to 23%, and revenue grew 11% as we captured higher demand in the market with attractive unit economics. The consumer net charge-off rate improved sequentially, as is typical with seasonality, and declined 170 basis points from the second quarter of 2025 to 12.8%. Our consumer results reflect the resiliency of the U.S. consumer that's benefiting from a stable labor market, steady wage gains, and moderating inflation. During June, the unemployment rate improved to 4.2%. Average hourly earnings grew 3.5%, and recent weekly unemployment claims remain low. In addition, even with persistent geopolitical headlines and energy price volatility, consumer sentiment has improved and consumer spending has remained solid. Consumer spending is a critical component of overall economic growth and a key driver of the health of small businesses. The June 2026 Fiserv Small Business Index showed expanding consumer spending at small businesses, with both sales and transaction volume increasing. In addition, the latest Federal Reserve Beige Book highlighted a resilient economy with expansion noted across most districts. In light of these trends, the most recent NFIB Small Business Optimism Index increased, reaching its highest level since earlier this year, driven by expectations for better business conditions and higher retail sales. In that survey, 2/3 of small business owners rated the overall health of their businesses as excellent or good. Additionally, our 11th Small Business Cash Flow Trend Report, released in conjunction with Ocrolus, found that 93% of small businesses expect moderate to significant growth over the next year, and 75% of these small businesses reported bypassing a traditional bank for their capital needs in favor of capital providers like Enova. Supported by this constructive backdrop, our SMB business had another solid quarter of growth and stable credit as we continue to leverage our leading brand presence, scale, competitive position, and intentional diversification across geographies and industries. Second quarter SMB originations grew 29% year-over-year. Revenue grew 35%, and the SMB net charge-off ratio remained relatively stable at 4.8%. Before I wrap up, I'd like to spend a few moments discussing our strategy and outlook for the remainder of this year and beyond. Our long track record of financial consistency across a wide range of operating environments demonstrates that our focused growth strategy works. We remain well-positioned to deliver meaningful financial results for the rest of this year and beyond, as our experienced and talented team leverages our unit economics discipline, diversified product offerings, flexible online-only business model, sophisticated machine learning-powered risk management capabilities, and our solid balance sheet. We're excited to build upon our proven capabilities with our planned combination with Grasshopper Bank, which we look forward to closing later this year. We remain engaged in a constructive dialogue with both the OCC and the Federal Reserve as the agencies continue their application review process. In addition, our integration planning is largely complete, and once we receive approval, we stand ready for a speedy close and will immediately start delivering on the significant synergies from geographic expansion of our existing products and lower funding costs from Grasshopper's existing deposit businesses. As a reminder, we expect the net synergies related to the transaction to drive adjusted EPS accretion of more than 25% once the synergies are fully realized in the first 2 years post-closing. To wrap up, we're pleased with our second quarter results, and based on what we're seeing today, we're raising our outlook for the year, which Scott will describe in more detail. We remain focused on continuing to generate sustainable and profitable growth while delivering on our commitment to driving long-term shareholder value and on our mission of helping hardworking people get access to fast, trustworthy credit. With that, I'd like to turn the call over to Scott Cornelis, our CFO, who will discuss our financial results and outlook in more detail. And following Scott's remarks, we'll be happy to answer any questions you might have. Scott?
Thank you, Steve, and good afternoon, everyone. As Steve noted in his remarks, we're pleased to deliver another solid quarter of top and bottom line financial performance. Our second quarter results reflect strong growth in originations, receivables, and revenue, complemented by solid credit, operating efficiency, and balance sheet flexibility. Turning to our second quarter results, total company revenue of $929 million increased 22% from the second quarter of 2025, driven by 28% year-over-year growth in total company combined loan and finance receivable balances on an amortized basis. Total company originations during the second quarter rose 27% from the second quarter of 2025 to $2.3 billion. Revenue from small business lending increased 35% from the second quarter of 2025 to $439 million as small business receivables on an amortized basis ended the quarter at $3.8 billion, or 36% higher than the end of the second quarter of 2025. Small business originations rose 29% year-over-year to $1.6 billion. Revenue from our consumer businesses increased 11% from the second quarter of 2025 to $477 million as consumer receivables on an amortized basis ended the quarter at $1.7 billion, or approximately 14% higher than the end of the second quarter of 2025. Consumer originations grew 23% from the second quarter of 2025 to $691 million, an acceleration from the first quarter that reflects the demand and solid credit we saw during the quarter. For the third quarter of 2026, we expect total company revenue to be around 25% higher year-over-year. This expectation will depend upon the level, timing, and mix of originations growth during the quarter. Now turning to credit, which is the most significant driver of net revenue and portfolio fair value. Second quarter net charge-off ratios for the consumer, small business, and consolidated portfolios were all stable or improved year-over-year. As a result, the consolidated net revenue margin for the second quarter of 61% was slightly better than expected. The consolidated net charge-off ratio for the second quarter was 7.3%, an improvement from 8.1% a year ago and 7.6% in the first quarter, driven largely by continued improvement in our consumer portfolio. The consumer net charge-off ratio improved to 12.8%, 170 basis points lower than the second quarter a year ago, while the small business net charge-off ratio was 4.8%, roughly in line with the 4.7% a year ago. These results underscore the consistency of our credit risk management and the quality of our originations. The consolidated fair value premium remained at approximately 115%, consistent with the levels we have seen over the past 2 years, indicating a stable risk-return profile and strong unit economics. The consolidated 30-plus day delinquency rate ended the quarter at 7.5%, essentially flat with the first quarter. Looking ahead, we expect the total company net revenue margin for the third quarter of 2026 to be in the 55 to 60% range. This expectation will depend upon the portfolio payment performance and the level, timing, and mix of originations growth during the third quarter. Now turning to expenses. Total operating expenses for the second quarter, including marketing, were 35% of revenue compared to 32% of revenue in the second quarter of 2025. As Steve noted, our marketing spend continues to be efficient and drove healthy originations growth during the quarter, especially from new consumer customers. Marketing costs were 22% of revenue, or $204 million, compared to 19% of revenue, or $143 million in the second quarter of 2025. We expect marketing expenses to be around 20% of revenue for the third quarter, which will depend upon the growth and mix of originations. Operations and technology expenses for the second quarter were 8.1% of revenue, or $75 million, compared to 8.3% of revenue, or $64 million in the second quarter of 2025. Given the significant variable component of this expense category, Sequential increases in O&T costs should be expected in an environment where originations and receivables are growing, and we expect O&T costs to be around 8 to 8.5% of total revenue going forward. Our fixed costs continue to scale as we focus on operating efficiency and thoughtful expense management. General and administrative expenses for the second quarter were $44 million, or 4.7% of revenue, compared to $41 million, or 5.3% of revenue in the second quarter of 2025. The current quarter includes $1.5 million of deal-related expenses associated with the pending Grasshopper acquisition. Excluding these items, G&A expenses were $43 million, or 4.6% of revenue. While there might be slight variations from quarter to quarter, we expect G&A expenses in the near term will be around 5% of total revenue, excluding any one-time costs. Our balance sheet and liquidity position continue to give us the financial flexibility to successfully navigate a range of operating environments while delivering on our commitment to drive long-term shareholder value through both continued investments in our business and opportunistic share repurchases. We ended the second quarter with approximately $929 million of liquidity, including $478 million of cash and marketable securities and $451 million of available capacity on our debt facilities. Our cost of funds for the second quarter was 8.1%, down from 8.2% in the first quarter and 8.8% for the second quarter of 2025, and we continue to see strong execution in the capital markets. During the second quarter, we acquired approximately 117,000 shares at a cost of approximately $19 million. We will continue stock repurchases opportunistically, while also ensuring we are prepared to close the Grasshopper Bank acquisition and transition to a bank holding company later this year. Finally, we continue to deliver significant profitability this quarter. Compared to the second quarter of 2025, adjusted EPS, a non-GAAP measure, increased 33% to $4.31 per diluted share, resulting in an annualized quarterly return on equity in excess of 30%. To wrap up, let me summarize our expectations. For the third quarter, we expect consolidated revenue to be around 25% higher year over year, with a net revenue margin in the 55 to 60% range. Additionally, we expect marketing expenses to be around 20% of revenue, O&T costs of around 8 to 8.5% of revenue, and G&A costs around 5% of revenue. These expectations should lead to adjusted EPS for the third quarter of 2026 that is around 30% higher than the third quarter of 2025. For the full year, we now expect revenue growth of 20 to 25% compared to the full year of 2025. With continued operating leverage, full year 2026 adjusted EPS growth of 30 to 35%. Our third quarter and full year 2026 expectations will depend upon the path of the macroeconomic environment and the resulting impact on demand, customer payment rates, and the level, timing, and mix of originations growth. As a reminder, our 2026 financial expectations do not assume any contribution from the pending acquisition of Grasshopper Bank, which, as Steve noted, we continue to expect to close later this year. The strength of our second quarter reflects the scalability of our business model, our diversified product set, and our unit economics discipline. Combined with the demonstrated ability of our talented team, our world-class technology, and machine learning-driven analytics, and a solid balance sheet, we remain well-positioned to continue delivering profitable growth and creating long-term value for our shareholders. And with that, we'd be happy to take your questions. Operator?
We will now begin the question and answer session. To ask a question, you may press star, then one on your telephone keypad. If you are using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star, then two. At this time, we will pause momentarily to assemble our roster. Our first question comes from David Scharf with Citizen Capital Markets. Please go ahead.
Hi, good afternoon. Thanks for taking my questions. Hey, to start off with, Steve, kind of wondering if you can provide maybe a little more color on what was behind the acceleration in consumer volumes. We kind of hear you loud and clear about the commentary regarding consumer health and resiliency. But it seems like over, especially the last year, SMB is, been far away the primary growth driver. And it feels like something changed in which you, if not necessarily expanded the credit box, you leaned into more marketing and volumes. Was there anything in consumer behavior that just felt or looked different versus 1 or 2 quarters ago?
Hey, David. Thanks for the question. So a couple things I would highlight. Number one, we didn't lean into marketing. In the commentary, really what I was trying to describe is really our marketing is an output of us meeting the demand that we see in the marketplace. So it's very dependent on the originations from quarter to quarter. In this quarter, we did see, healthy demand overall in the consumer space. In particular, if you take a look at what's happening with our portfolio, I think SMB's been a very consistent grower, as you've talked about. On the consumer side, installment loans, if you take a look at our supplement, has been a very steady, year-over-year grower as well, where some of the growth has come from in the past couple of quarters has been more in the line of credit space on the consumer side, which, if you may recall, last year, that was an area where we had slowed down a bit because there were some things that we didn't like. So the year-over-year growth pickup, some of that is a slightly easier lap from last year and somewhat focused in that product, which again is a very popular product across consumers, a product that we've differentiated very well and that's very well received by our consumers. So I think what you saw on the consumer side is a reflection of that strength and resiliency in the consumer space that I highlighted, an increase in demand that we saw during the quarter, and us being able to capture that demand very consistent with our risk appetite, which hasn't changed, in the unit economic requirements that we have to book new loans.
Got it. Understood. And maybe just kind of related to that, the net revenue margin outlook, that 55 to 60% range for the full year, that sort of existed in your guidance for a couple of years now. And, as we think about whether there could be an annual figure above 60 at some point, is there anything that's just sort of unusually strong about the 57% consumer net revenue margin this quarter anything about that you would suggest we shouldn't rely on that as sort of a new benchmark?
Yeah. Hey, Scott. I think, we've been pretty consistently in that 55 to 60 range on a consolidated basis and think we'll continue there. You're right, the consumer was a little higher, and that's a reflection of the strong growth and solid credit that we're seeing. But, we expect that within the historical ranges that we've been in with consumer, it's usually a little lower, so kind of reversion to that. But overall, a good outlook on both SMB and consumer credit that will kind of keep us in that range we provide.
David, I would just add that, we typically sit around 50% on the consumer side, plus or minus. And as Scott said, as we start to see some of the LOC on the consumer side sort of lap those periods from last year and sort of settle in, you'll start to see that sort of revert back just the way our unit economics work. That's what we would expect. That's what's in our guidance. And SMB, sort of sitting right in the center of our expected range of 60 to 70 that we typically would see. So I think as Scott said, the higher originations growth, particularly when it's accelerating, can drive a little bit higher net revenue margin within the range, but you shouldn't count on it being at that elevated level.
Okay, good. No, that's helpful. It definitely stood out. Hey, if I can just maybe ask one final one. Listen, I know in the bank application review process, you're very limited in what you can publicly discuss. Just wondering, is there anything you could help maybe just educate us a little on kind of the nature of the process in terms of, are you still in sort of an iterative, question and response kind of period? Do the reviewers at any point in time provide updates on their expected timing or backlog? Just, if there's just any incremental, color that would be helpful.
Yeah, I have, a lot of respect for the agencies and the process that they follow. But as I said on the call, I think we remain in a constructive dialogue with both of the agencies as they're going through that process. So I don't think there's a lot of additional color to provide beyond that. We've pointed to the second half of the year since the beginning. We're 3 weeks into the second half of the year. I have a lot of confidence in our application. I have a lot of confidence in the process, and I look forward to closing later this year.
Great. Terrific. Thank you.
The next question is from Bill Ryan with Seaport Research Partners. Please go ahead.
Good afternoon. Thanks for taking my questions. First question is just on the credit, looking at the delinquency numbers. Consumer, obviously, year over year looked really, really strong. And the small business delinquency rate was up a little bit, I believe 6.6 to 7.4 this year. And that impacted the change in the fair value marks that ran through the P&L for both consumer and small business. I was wondering if you could maybe elaborate, kind of what you're seeing in the mix between the two, like specifically on consumer credit, what's driving some of the looks to be outperformance, and was there anything going on specific in the small business lending? Thank you.
Yeah, sure. Thanks for the questions, Bill. I think on the consumer side, as we talked about towards the end of last year, we were seeing some of the best credit that we had seen in some time. And we had pointed to the fact that we were going to capture some of that growth, obviously with the focus on our unit economics. And I think you're starting to see us continuing to optimize our growth within that framework. And so, yeah, we're hanging around sort of a lower end of our typical net charge-off range, for example, on the consumer side. But I would expect us to sort of settle back into those more typical ranges, which, again, as I mentioned earlier, would drive some reversion back in the more typical net revenue margin ranges. And that's all sort of expected in our outlook. I think on the SMB side, it's been remarkably stable. You can see quarter to quarter we can have some growth variations, but we've been, very healthy growth. Our net charge-off ratio has been hanging within the 4 to 5% range that we would expect every quarter for quite some time. And the delinquency ratio that we printed this quarter, relatively, stable on a sequential basis, but compared to a year ago, we had some pretty low delinquency levels back last year, and I think it reflects the team's ability to capture some of the growth and optimize within our frameworks, and continue to drive our ability to serve as many customers as we can within that framework while, delivering within the credit risk that we would expect. So I think you should expect more of us operating in that 4 to 5% range on net charge-off. The delinquency number can move around a bit depending on the period-to-period growth. But I feel good about us being able to deliver on that for quite some time.
Okay, and just one follow-up on the yield on the consumer portfolio. It did move up, looks like about 400 basis points quarter over quarter, and I assume that's the product mix going a little bit more to the line of credit. If you could talk about that, and do you see some additional upside in that yield?
I think if you take not just the last quarter, but look back over the last few quarters, it's been right around 115% for quite some time. And I think that's kind of where we landed this quarter. So I would expect it to level out around that level plus or minus from here.
Okay. Thanks for taking my questions.
Yeah.
The next question is from Vincent Caintic with BTIG. Please go ahead.
Hey, good afternoon. Thanks for taking my questions. Great results. I wanted to kind of ask a follow-up on the marketing. So marketing came in, the percentage was higher as a percentage of revenues, but your revenues were also really strong, so kind of an overall beat there. But the marketing dollars came in, higher than the initial guidance. And I was sort of wondering from a macro perspective, if you could, you kind of touched on what you saw and the opportunities you saw. Is that macro environment or is that opportunity still existing in the third quarter? Can you lean into it? And so I'm basically trying to delve into the framework of the kind of your guidance, which has been consistent in the, in the medium term for some time versus the opportunities that might exist today, maybe to lean into marketing and originations further. Thank you.
Yeah. So, again, I want to just clarify, like leaning in, what we intend to do, what I was, again, trying to communicate was that with our capabilities on tech and analytics and our real-time feedback, that allows us to move quickly on the demand that we're seeing, and working, again, back from the ROEs and the unit economics that we would expect. In terms of the environment, Vincent, I mean, they're not going to change dramatically from, week to week. And I think the latest stats, including like the unemployment claims this morning, were very strong. So it feels like the employment situation, despite some of the volatility in energy prices, which have been sort of skewing some of the spend statistics, which underneath that are pretty strong. It feels like the consumer overall is hanging in there pretty well, given the labor situation, and is pretty resilient. The other thing I would tell you just about marketing, if you just take it as a percent of originations, that's probably the better way to look at it. And on the SMB side, I don't think there was anything remarkably different particularly as it relates to our commissions on originations. I think we had a touch higher on new customers on the consumer side, which probably had a bit more to do with which we're happy to have because those new customers will be returning customers in the future. And so that drove a touch of the marketing beat. But overall, really good, positive growth that's going to deliver really good unit economics for us.
Okay, great. That's super helpful. And then separate question about Grasshopper Bank, and I know we can't talk about the acquisition mechanics, so we won't talk about the regulatory part. But I've been paying attention to the news that have been coming out of Grasshopper's press releases, and it seems like they're doing a lot of interesting things beyond what we would think about as like SMB lending. So just looking at their website right now, they're launching instant payments on stable coins, treasury management, expense management for small business, and a lot of interesting high growth areas in when we think about some of the fintechs out there in the commercial space. And so, we kind of think of Grasshopper in terms of the funding side, maybe in terms of some product synergies, but I was kind of wondering maybe if you can talk broadly about how you're thinking about Grasshopper and sort of the fintech things that you can get into as, on a combined basis with a couple of these interesting ideas on the commercial side. Thank you.
Yeah, sure. It's a great question. Well, I mean, I think you're recognizing why we thought Grasshopper was such a great partner to combine with. Mike Butler and his team are, very innovative and have done a great job of building payment and banking and deposit and lending capabilities, in particular on the commercial and small business side. So I think some of the press releases on product releases that you see reflect that. we're excited. First of all, I think the most important thing we're excited is just to close, because that's what's going to drive the bulk of the synergies that we've talked about, really just the expansion of our existing net credit products and our ability to tap into the great deposit programs that Grasshopper has. You're getting a little bit of a preview into the future of, our ability to innovate within the two companies, in particular as you start to see things like payments and banking converge. So we're really excited about it. Our focus right now is on, getting to the close and starting to deliver on the known synergies and quickly pivoting to the innovation roadmaps that we know are going to be pretty exciting to talk about in the future.
Great. Very helpful. Thank you.
Again, if you have a question, please press star then one. The next question is from Kyle Joseph with Stephens. Please go ahead.
Hey, good afternoon, guys. Thanks for taking my questions. Just to round out kind of the near-term NIM outlook, you guys talked about expectations for consumer loan yields. Can you give us kind of any color or changes you'd expect, or whether they'd be stable on small business? And then in the interim, before the acquisition closes, any changes you'd expect on the cost of funds side of things?
Well, let me talk about the SMB, and then I'll let Scott talk about cost of funds. But, I think our yield on the SMB side has been relatively stable. A lot of that, I guess it ticked up a little bit recently, like in last year's period, as we were focused on some of the strategies that we had highlighted in earlier periods around some of the good opportunities in terms of unit economics in some of our higher APR segments, which we delivered on. Clearly, you can see. I think we're starting to see our balance of origination settle back to more typical levels. So I think the yield where we're sitting at this quarter is probably plus or minus pretty close to what you're likely to see in the foreseeable future, given the mix of originations that we would expect on the SMB side.
Yeah, and then Kyle, on cost of funds, I think we'd expect that to be, pretty flat to possibly down if we can, as we continue to look at the capital markets. They're pretty strong right now for us, and so we've got a few things done, just one renewal in the quarter, so not as active as maybe we normally are, but that did come with a credit spread tightening. So, execution is there, and, good outlook in the capital markets. We'll see what rates do as we move along, but not expecting a huge change on cost of funds, but it should be, where it's at or better.
Got it. Helpful. And then just following up, I think a year ago, you guys really highlighted some of the underwriting changes in consumer, and then I think towards the end of the year got more aggressive there. Appreciate, Steve, the color you just gave in terms of kind of the mix shift on SMB, but in terms of kind of risk appetite on SMB, I know you guys talked about, confidence remaining really strong from small businesses, but just any sort of underwriting changes you've had there over recently.
Yeah, our risk appetite has not changed, Kyle. We've had a very consistent approach to how we're tackling credit for our decision making. So what you're really seeing is the power of our brand resonating with borrowers and the demand that's in the marketplace. So just to be clear on both sides, both portfolios, both consumer and SMB, our risk appetite's been consistent for quite some time.
Got it. Very helpful. Thanks for taking my question, guys.
You bet.
Again, if you have a question, please press star then one. The next question is from John Hecht with Jefferies. Please go ahead.
Afternoon. Congrats on another great quarter. The question I have, and you may or may not be able to answer given where you guys are in the journey of acquiring Grasshopper, but maybe could you give us any, if it is approved, if and when it's approved, will there be a shift in geographic focus, or would there be a mix, a shift in either consumer or small business, given the framework that it would be under?
Hi, John. Yeah, thanks for the question. So I would expect that soon after close, with some of the benefits of having a national bank charter that we've talked about on prior calls, we'll have the ability to expand our consumer products, which is only going to be net credit within the bank. We'll have some opportunities to expand our geographic reach with our bank directly. Today, SMB is already in all 50 states, but there will be some opportunities to tap into some capabilities there. In addition, with some of the existing small business products that Grasshopper has, which will serve as an adjacency to some of our existing small business programs. So the revenue synergies that we've talked about is really related to us just doing what we do with net credit in some new geographies. So something that we're prepared to do and have been planning to do once we get to a close.
Okay. And then, how much you guys have clearly been growing nicely. And then, we've heard that there's very strong loan demand. It's obviously healthy loan demand given the credit characteristics. But are you able to attribute how much of your growth is market share gains versus just a function of, an active borrower?
Yeah, it's always been a struggle to highlight that, but my guess is that we are clearly taking share in both business segments with the growth rates that we're printing. So obviously those markets aren't growing that fast, so clearly we're able to capture demand not just from new entrants into the space, but also from customers that perhaps aren't satisfied with their current providers. And they're coming to our brands for a better experience. So that's I don't, have an exact take on it, but it's clear that we are taking share with our capabilities.
Okay, great. Thanks very much.
Thank you.
This concludes our question and answer session. I would like to turn the conference back over to Steve Cunningham for any closing remarks.
Thank you. We appreciate you joining our call today, and we look forward to updating you next quarter.
Conference is now concluded. Thank you for attending today's presentation. You may now disconnect.